Afternoon. This is Kelly Buckley. Good afternoon. This is Kelly Buckley, and it's July 20th of 2020. And welcome to this segment of our Facebook Live, where we're going to talk about the election's likely effect on your investment accounts and also provide some updates on COVID-19 effects that we feel are likely going forward on our economy. And to start, I'd like to also address some frequently asked questions and thank those of you who sent these questions in, because if you're wondering, there's probably a lot of other folks out there wondering as well. And a question that we're getting a lot now really is kind of related to the 2016 election, because there was such a disparity between those two candidates' views that the question of Secretary of State Clinton's election versus Donald Trump's was heavily mentioned by many people. And so now we come into another election cycle where the views are even more polarized. Secretary Clinton, if she was running in 2020 with the same views, would be seen as far too right of left views to even be considered as a candidate for the modern Democratic Progressive Party. So I'm going to go back and revisit 2016. Most of you have been clients for a while, know we called that election based on the Electoral College count in September of 2016, well before the November election. We did that by conducting our own independent analysis state by state at an Electoral College level, because that's how we elect our president. And we've conducted the same review now. We're well ahead of where we were in 2016. And it appears imminent to me and verifiably correct that President Trump will be reelected. And it's likely to be an even greater margin electorally than we saw in 2016. Now, I guess the real reason there that we need to kind of be looking at is the likelihood that the views of these two candidates will weigh on voters' minds when they enter the ballot box. But let's say that we're wrong. Let's imagine that the scenario we envision is 180 degrees out, and that rather than President Donald J. Trump, it's President Biden. What happens then to your investments? Well, first, when we were talking about Secretary Clinton in 2016, I always referred back to her past votes. You can do the same thing with Joe Biden. Past votes in the United States Senate. I look at their past pattern of political contributions, and I come to the same inevitable conclusion. And that is, even though Joe Biden has changed his views remarkably in the past 6 months or so, after 47 years in DC politics, he still is a creature of the swamp. And I believe, as I believed then, that he is bought and paid for by the United States Chamber of Commerce, and in particular the financial service industry, both of which have given him millions and millions of dollars over the years. I think as a creature of the swamp, which he clearly is, that he will maintain those closest ties, and that his job performance will be influenced greatly by those contributions. For this reason, I think a Biden presidency, while it would cause the economy to stagnate somewhat, would not be the tidal shift that many project or predict under President Joe Biden. I think it's likely to be incremental at best, and any changes he did make, whether they're regulatory, done by executive order, or by trying to influence congressional legislation, would likely run into significant roadblocks in a conservative Senate, where we believe strongly, having looked at those states as well, that the majority will be maintained by conservatives. We think he'll be stopped there with any legislative initiatives. We also think the over 200 federal court appointments that the Trump administration has put through in his first 3.5 years in office are likely to cause court decisions not to be in accordance with progressive socialist views. So I think that a Biden presidency gets stopped in two ways: from doing things that overtly harm capitalism or the U.S. economy, and they're both synonymous, really, and that is the Supreme Court and federal appeals courts, district courts, and circuit courts, as well as the United States Senate, who you have to get the legislation through if you're looking for legislative solutions. I don't think it gets through there. The re-election of our current administration, and more importantly, the re-election of their policies, which are freedom-driven, which are life-driven, which are capitalism-driven, which are driven by sentencing reform, criminal justice reform. Those policies are very, very likely to be re-upped in the November election. Another question I've gotten a lot is, do we expect there to be a dip in the market with the recent COVID-19 resurgence? And folks, I want you to know that we are looking at CDC, Johns Hopkins, and other website statistics on a daily basis to make sure that we are fully abreast of the COVID-19 situation. And I'd be the first one to admit, sometimes you get conflicting views. Not often of the raw data, though. The conflicting views come from interpretations. Many times interpretations differ due to political philosophies, which I think is a doggone shame, because the science truly should rule on this. So my answer to this question is no. I think the market's broad movement is dependent primarily on our economy reopening, but given the ability to, as we talked about a couple of weeks ago on our Facebook Live, throttle on, throttle off, seek out the hot spots like we have in some isolated areas of our country right now, shut those down, but don't shut down the economy nationally or regionally or even on a state-by-state basis. I think that is very, very likely to be the policy that's continued. And so I think the economy is going to continue to emerge even with COVID-19 hotspots. And I want to talk about why. There's no question when you look at it, whether it's on a national level or a state-by-state or regional level, that the number of COVID-19 cases that are being detected by testing has gone up, no question. But that's because we're doing a lot more testing. In conjunction with that, even in the problematic states like Texas, Arizona, Nevada, etc., we're seeing the death rates, the rate per million, continue to drop significantly. So we're detecting more infection, but it's not causing higher death tolls as a percentage of our population. In fact, that percentage is plummeting. We believe, and we said this in February in our March social media posts, we believe at the end of the day that our mortality rate here is going to look remarkably close to a really bad common flu season. And that if you're under 70 years of age, the mortality level is almost nil nationally and on a state-by-state basis. Almost nil means percentage is very, very small. The folks 70 and over who are dying of this disease, who have to contend with it, who we need to shield, who we need to quarantine, do not require us to shut down the economy. That's not necessary. It's necessary we protect the vulnerable. That would be our older Americans, our more experienced Americans, I should say, and also those who are compromised, who have comorbidities, asthma and obesity, etc. Those folks know who they are, and they are quite capable in our freedom-loving society of quarantining themselves. That's who we need to shield. We need to get our kids back in school, like so many other countries in Europe and in other continents have done quite successfully. We need to allow people who are at a healthy age to work. And here's my bottom line. We need to recognize that we're all going to get infected with COVID at some point, unless you're quarantined. It's like the common flu. How many of you have never had the flu? I don't know anybody that has. I think we all get it. I think we've got to protect the vulnerable. I think we've got to continue to protect our economy and the American way of life. These things are critical, including the criticality of our children's education. They are the next generation of leadership in our schools. They don't need to suffer for misinterpreted science. Children are not negatively impacted by COVID statistically. There may be isolated incidents where that is not true. That's still in question. But it's clear that the schools need to reopen, our children need educations, and their parents, unless they're compromised adults or elderly, need to work. Next question that's come up a lot is, do we think this is a good time to refinance? Those of you who are reading our social media, and folks, I wish all of you would please look at our LinkedIn, our Twitter account, our website, and other mediums that we use to get the word out daily, because we've talked about this, but we're still getting the question. There is no question in my mind that if you have an interest rate that's 1% or better above the current world record lows on the 15 and 30-year rates, you do need to refinance. Those rates are 2.73 on a 15-year and 3.15 on the 30-year. So if you're 1 percentage point above those rates, you need to refinance. This morning I was reviewing a client profile that we did recently and noted that that client had a 4.25% 15-year mortgage that they had just completed a little over a year ago. That's an absolute must-do for a refi, and because of their age, they could go to a 15-year from a 30-year, and they would still benefit cost per month wise. In addition, I think there's one other important point here. If you have non-deductible debt that you've built up, perhaps during the pandemic, due to employment issues, or maybe debt from cars or other types of non-deductible debts like home equity loans, which many do not realize are non-deductible now, but they have been since January of 2018. Those debts could be rolled into a new lower interest primary mortgage, resulting in write-offs for the interest you're paying on them, and a very, very likely lowering of your debt level, of your debt interest rate. So do the refinance now, and if you refi, look at any other debt you have. If you have any questions here, please call our Director of Financial Planning, Mike Reich, or myself. We're both CFPs and we can guide you here. Our firm is also able to refer you out to very experienced mortgage loan officers who could be of assistance to you in that endeavor. And we have some great ones that make what is usually a miserable process much, much more enjoyable. Next question we get on, in kind of related to this, is how long will interest rates remain low? And you know, this is an open question. It's very difficult when you look at all the variables here, but I'll give you my opinion. I think we're going to see rates remain low for approximately a year. The Federal Reserve, who unilaterally controls short-term interest rates, in other words, they set them by their unilateral control of the Fed funds rate and discount rate, which are very short-term rates. The Fed has already told us to expect those rates to remain at a very low level through 2022. I think you've got a year. I don't think it'll go through 2022. The Fed often changes its mind, and they should, based on new data. I think they're going to see new data because I think the pandemic goes away at a much faster rate than political and economic pundits think right now. And as that occurs, you're going to see rates start to move upwards towards let's say, an equilibrium or a more normalized rate level. So over the next year, you've probably got a great window to refinance. Don't wait later, though. Rates could move up rapidly in the next 6 months. Next question we get is, and this is very important to me and to our firm because we want you all to understand clearly our investment methodology. Why didn't we sell to prevent this recent decline? And I think the answer that is probably most cogent to this question is because selling would have been unwise. And I want to give you some examples of that in just a moment. First, our firm is a predictive, concentrated investment style. I developed it. It's not something that we were taught. It's something that I began learning as a very young guy 50 years ago. And then when I became a professional in the industry 33 years ago, worked very hard to modify and perfect, if you can ever perfect anything. This is an ongoing practice and learning lessons every day. So we don't sell in our style on what I'm going to call glitch events. And what is a glitch event? A glitch event is something that occurs that creates some economic or investment dislocation, but it's a very short-term event, maybe a quarter, 2 quarters, 3 quarters, something like that. I define COVID-19 as a glitch event. And I'll tell you, I'm an outlier on that. We have many people who have already accepted this idea that it is an earth-shaking, earth-shattering event. They are the same people that in December of 2018 and throughout the fourth quarter of 2018, next slide please, told us that we were going into a recession immediately. Told us we may already be in a recession. They told us that the yield curve was going to invert. We wrote widely about this throughout the fourth quarter. And we said clearly there would be no long-term or intermediate-term yield curve inversion. And in fact, there was none. We said clearly that no recession would result if the yield curve in fact had inverted, because usually economies and markets don't top out for about a year after a yield curve inversion actually occurs. We said that we believed the dip in the fourth quarter of 2018 was a glitch event and that we should buy into it. And in fact, we sent our clients a letter dated December 24th of 2018, identifying that day as what we believed was capitulation selling and a market low that would likely last for years. If you note this chart down here at the bottom, there's December 24, or correction, that's 2016. Let me go back. Let me see here. I apologize. Yeah, here we go. There's December 26, the first day after we called the low, through the end of 2019. Spectrum's returns 49.31% net. That's all accounts net of all fees. The S&P 500 price return only 38.57%. But there's a lot of other glitch events up here, folks. We called them. We called the market low to the day of the low in a letter to you in February of 2016. And you notice our return disparity there. We considered the sell-off that had occurred to be a glitch event. We called it again in June of 2016. And then you'll see our 2019 returns following the December 24th, 2018 market low call. So our firm's investment philosophy dictates that we do not sell in short-term economic or investment dislocation events, or again, what I commonly call glitch events. When do we sell? Because this is critical. We sell when we perceive that there is a recessionary event occurring. Recession is defined by multiple college texts and by the National Bureau of Economic Research as 2 consecutive quarters of gross domestic product decline. And all that means is that our nation's economy is having fewer goods and services produced than it did the previous quarter. And it does that back to back, does it 2 times. If we think we're in a situation like that, as we did back in September of 2008, then we're going to take the majority or all of your portfolio to cash and protect it. If, on the other hand, we think it's a glitch event, as we saw here, we're going to ask you to consider investing more, and we're going to maintain your positioning. So 6 months of pain, if we have to go through that, I don't know if it's going to be that long, but that would put us into late August. We think that's worth it to produce what are likely to be above average returns, as we did in each situation here. I know there may be other questions that come up about that. Feel free to throw them up, both either on this Facebook Live or send us an email or call the office if you would like to, and we'll address them here as we go. Okay, excuse me. A couple other things I want to mention in terms of our portfolio management. First, we like to buy in times of fear. And I know that may make it unsettling for some, but where we see opportunity, we feel that we should exploit it so that you achieve a long-term high potential for above average performance. I also want to mention that we track our performance very, very closely. Why is that? That's because we believe that performance matters. If you looked at your median client account at the end of 2019, we judge performance on an annual basis. Our median client had a return that was over 12% net of all cost, annualized, going back through the first of 2009. But Dalbar does a study. Dalbar is a very large econometric firm that measures investor returns. They do a study every year of average investor returns. They found that over that same period of time, the average return was less than half of Spectrum's clients. Less than half. That means that over that time, those investors lost a doubling of their accounts. Returns matter. Performance matter. It does in every area of life. It's what's important to us as a firm, is to give our clients an edge. Your portfolios include companies that we believe are fundamentally undervalued and have high potential for above average performance. We're not just buying the market to do that. We're not over diversifying your account and buying sectors that are doomed, we believe, long term, to underperform the market. Let me cover once again some of the drivers of economic performance that we see, because I'm going to tell you something. We truly believe that over the next 3 to 5 years, our economy is going to see a dramatic resurgence that will mirror the results achieved from January 2018 to February of 2020. And that's driven by policy changes at a national level. The same policies that are under attack now by the political by the political opposition to our current administration. But here are some drivers we really got to think about hard. From fiscal stimulus through the Congress and stimulus put on our economy from our nation's Federal Reserve, over $8 trillion has been piled on the United States economy on top of the COVID problem. That is now. We have another period of stimulus, our fourth, that's likely to come. And it's rumored to be anywhere from $1 trillion to $2 trillion. If it happens, it'll be sometime likely over the next 2 weeks or so before Congress takes another vacation. That $8 trillion is more than 3.5 times the most stimulus in real dollar terms, inflation adjusted terms, ever used to come out of the worst situations we've faced, including the Great Depression. The China and USMCA trade deals, Mexico and Canada, have already kicked in. They kicked in June, full force. We're going to feel those effects for decades. Possible infrastructure planned spending is going to occur. Could occur in this fourth wave of stimulus, but it's probable we're going to see something this year. Both the Democratic Party and the Republican Party agree that's necessary, and they both need it to hang their hats on going into the November elections. The reemergence of American manufacturing dominance continues. Companies are bringing back factories from mainland China. And one thing that we've learned from the COVID-19 affair and from an examination of China's trade policies is that large American companies and the United States Chamber of Commerce need to bring those factories back, allow Americans to hold those jobs. That will lead to greater economic growth. It will help us secure the vital strategic national interest we have in maintaining pipelines for our pharmaceuticals and our precious metals, which we literally have no control over right now. I believe that we'll see hundreds of companies in the next 2 years relocating their factories with hundreds of thousands of jobs moving from mainland China back to the United States of America. That's a huge synergistic effect on our economy. National security policy changes are coming into effect that will make it very difficult for the Chinese to extort putting their Chinese nationals in high leadership positions in American companies where they have 100% access to our production ways and means, to our infrastructure, to our secrets, both on a national defense level and on a corporate secrecy level. Those changes are going to secure our intellectual property, which Chinese have stolen for decades. Retail, low-pay, non-benefit kind of jobs, that would be primarily, again, retail, are transitioning into manufacturing jobs, which come with a livable wage and generally come with benefits. So this is going to help lift our nation's middle class, which hemorrhaged wealth to China and other countries following NAFTA's passage in the early 1990s. Pent-up demand is driving vacations, driving airlines, driving hotels, driving banking, car manufacturers, and pretty much everything else from folks who've been cooped up for a long time. Those folks are realizing there's not a lot of reason to be cooped up if we social distance and wear masks when you can't social distance. Another question that's come up is addressing the bank sector. As you all know, that's our single largest sector. I am convinced it'll be our biggest wealth creator in the next year to 3, maybe longer. So I want to talk about Bank of America because this was specifically brought up. Bank of America announced their quarterly earnings and revenues about a week and a half ago. And both revenues and earnings beat analyst expectations, as we suspected they would. Citigroup did as well. I should add that. So in the second quarter, their net income at Bank of America was $3.5 billion. That beat analyst expectations. But one thing analysts didn't expect is they didn't expect those earnings to occur with $5.1 billion being set aside for potential loss reserves in their loans. That means they beat with a world record earnings charge of $5.1 billion. Now, Bank of America is doing the right thing. They're being conservative. So I applaud them for doing that. Citigroup was conservative in theirs too. What's likely to happen, folks, is the economy will reemerge as it has since early to mid-April at a rate faster than expected. As that occurs, those loan loss reserves will be pulled back into earnings and be reflected in the third and the fourth quarter of this year. That means, again, earnings coming in at a much, much higher than progged level. So this is kind of like a savings account that you know you've got that's going to be spent very soon. And it's going to help push the stock price. I want to also say on our bank holdings, I am of the belief that those holdings are 30% or more undervalued prior to the end of this year. I think their undervaluation in the next year to year and a half is probably a multiple of 2 of that. Our banks are undervalued by every historic norm. Whether we look at price to earnings ratio, price to earnings growth, every historic norm is telling us bank earnings are at a level now that are healthy enough to support much higher stock valuations. As the market starts to rid itself of COVID fears, and it will, the question is only when, those valuations will creep back up to normal levels. Another question that's come up from clients is addressing Boeing's current back orders and when these planes are likely to be delivered. Many of you, if you're following the Boeing saga, know their problem began with the 737 MAX and problems with their MCAS system. That's a stability augmentation system. Boeing's had to address a lot of problems there. And several weeks ago, they had 3 flights in 1 week to test the evidence that they've solved that problem. We don't have a release on that information yet. I am of the opinion that problem is solved, and air regulators, air safety regulators at the FAA, Federal Aviation Administration, helmed by a great leader by the name of Steve Dixon, will be making the decision on when to recertify the 737 MAX. I think it'll be done by late summer, early fall, but it could be earlier than that. We believe that Boeing stock now is inherently undervalued, and the stock price is likely to go up more than 40% prior to the end of the year, primarily centered around timing issues from the FAA's approval process. We would continue to hold and accumulate Boeing shares. But let's talk about back orders now to answer that question specifically. So right now, their backlog is approximately 4,552 airframes. That's a backlog of orders yet to be delivered. That's years worth of backlog. Now at the end of 2019, prior to all the cancellations, the bad press, etc., it was 5,900. Could it dip more? Absolutely it could. Will it? I'm not certain we got much more to go. There may be a little on the tail end of this thing, but I think we're clearly in the tail end of order cancellation. And I think it's also important to point out that 10 years ago, they had an order backlog of 3,300 airframes. 3,300 compared to now 4,552. And what happens when the 737 MAX is flying again? Which it will be. It's a question of timing, not if, in our view. Well, people are going to start to place their orders again. Economy's going to be picking up. Airlines will go, oh, business is coming up again. It's good. We can afford it. And frankly, they can't afford not to, given the efficiency that the 737 MAX works at compared to older airframes. Some point they absolutely have to upgrade. Then those orders come back in, the same orders that were canceled, and more. And what I always try to do when I look at problems like this and try to make decisions on likely outcomes is I put myself in the CEO's position or in the chief pilot's position. If I was a chief pilot in a major American airline or an overseas airline, I'd probably realize that after all the heck that Boeing has put themselves through due to operational mistakes, they are going to have the safest airframe in all time, probably going to exceed their competitors' airframes in safety. Boeing is in a position now where everything they do is looked at under a microscope. That raises the level of safety in their airframes, which was always good, except on two occasions where it wasn't, and that resulted in deaths. It's a tough business, but their airframes are likely to be the safest made in the world. So if I'm a CEO, Boeing is going to get a really, really hard look from me, and I'm going to recognize that when I negotiate pricing with Boeing, they're also going to be flexible, maybe more so than their primary competitor, Airbus. Next question that's come up is it true that Bank of America gave $1 billion, that is with a B, to Black Lives Matter? And should we be supporting this company? And the individual brought this up, who's a very wonderful person, said it sounds like a marijuana stock. I don't know if y'all have ever heard me make comments about marijuana stocks, but I can't own cigarette companies that kill people. I can't own marijuana manufacturers that I think increase the drug-addledness of our society. Just can't do it. And for that reason, I've never bought those companies. So I don't think that Black Lives Matter necessarily fits into that time frame, or that market space, because I don't think they necessarily kill people. But I'll talk about this and I'll let you know what I think here because you asked the question. So I researched this after it came up because I had not heard this. Now, Bank of America has given significant money to black charities. To the best of my knowledge, that does not include BLM. But they have given to traditionally black universities and colleges and funded scholarships, etc. Black Lives Matter publicly, in my opinion, has a great cause, and that's racial equality. And there's a lot of things you could look at with civil rights pioneers and throw, aspersions at them. But standing up for racial equality, in my opinion, is great. And I've done that my entire life. And I was privileged to go to an extremely diverse high school, which everybody in the state knows is the best in the state. That's Bryan Station High School in Lexington, Kentucky. And because of that, I had the opportunity to be around a real diverse population. And thank goodness, because I tell you one thing, they made me better in every way. So I agree with the publicly stated cause of the BLM movement, which is racial equality. I do not believe that we are systematically racist. And anyone that does needs to write a definition down and send it to me. Because I had the privilege of working in this industry for 33 years, and not one time have I seen issues with what I would consider to be systematic racism. I'd consider that to be decision-making based on race that negatively impacts one race over another. I also didn't see in the United States military, which I was privileged to be a member of for 25 years, and where I saw comments come up, they were quickly put down, and they were so rare, so few and far between. It's almost unbelievable to me that anyone is in an industry where they see it often. I certainly don't think it's in our police departments or any of our law enforcement agencies. I saw a quote by an officer in Seattle, a black police officer, who who was talking about some mamby-pamby white guy with his tight pants on, screaming in his face that his nose was big while he was protesting for Black Lives Matter. Black Lives Matter has a good public mission, but they have been hijacked or they're complicit with anarchists and communists and socialists under the guise of Antifa. They're the ones who are still burning Portland right now and Seattle and raising their ugly heads in other poorly governed cities like Chicago. This last weekend is just so horrible in terms of the cost in life. And does this affect your investments? Yes, it does. And that's not why I'm upset about it. I'm upset about it because people are legitimately being injured and dying, and our brave police officers, that would be the 98% of them that have their heads on straight, that are truly there to serve and protect. They're taking a lot of abuse, folks, and they're being injured, and they're being put into hospitals, and they're being stabbed, and they're being shot at, and they're having explosives tossed at them. None of us should tolerate that. And because Black Lives Matter has a good public mission does not mean that we have to be afraid to be called racist if we don't agree with what actually is going on the street level, because it has been hijacked by people who hate our country, who hate freedom, who hate life, who hate capitalism, who hate everything about America. And they're pulling down the statues of our founding fathers and mothers and religious figures. And as a company of faith and tolerance, we abhor that. We do not think it's a legitimate source of First Amendment protest, and it should stop immediately. It is negatively impacting our economy. These businesses have to shut down when they're burned out or when their owners are too scared to walk into their storefronts and open the door. So Bank of America, I don't think, has done anything other than help charities that deserve help. And Black Lives Matter has a good public purpose because their lives are really important to me, and I know to you. So are mine, my kids, your kids, all American lives, all lives everywhere. Haley, do we have any questions?
We did. We had one question that came in. Do you have any thoughts on the companies that make no profit like Tesla and their stock's still going up?
I do, folks. Boy, this is a tough topic. You know, the tech sector right now is so much like it was at the end of 1999. So 20 years ago, 20 and a half years ago, valuations were sky high in comparison to the average company. And when I say their valuations, I'm talking about how many dollars somebody will give for Tesla versus their earnings. Tesla is overvalued by a factor of 10 to 15 times. It's obscene. And truly, to me, companies like that, and there are other examples of that, of course, in the tech sector, they are going to have a very rude awakening, and eventually they will plummet. So the investment in Tesla depends on what is called the greater fool theory, and it is, I'll buy it because it's gone up 35% year to date. And some other fool will give me another 35% for prior to the end of the year. You could equate that to a Ponzi scheme. Both of them fail 100% of the time, and Tesla will fail. As Tesla's competitors continue their development, the research and development work in hybrid vehicles or electric vehicles, Tesla will eventually be ground into dust, or at best bought out by one of those competitors, but certainly not for this obscene valuation. They'll wait until Tesla falls 12 or 13 times then they'll write in like a white knight and say, hey, we'll buy you. And then Elon Musk and his minions will still walk away billionaires, but that company will cease to exist. This is what has always happened with these type of high flyers. There are very, very few exceptions to that. Anything else?
That's it from everyone.
Okay, so this last slide I didn't really cover, but I should have. Our country has always stood for equality of opportunity. That's what the Constitution of the United States gave us. For that reason, when I was 18 years old, I wasn't even 18, I was 17, and I was finishing my United States Air Force Academy application in late December of 1974. When I got down to the bottom and you had to check the block on your race, I just checked something like Caucasian other. And as you all might be aware, preferences are given for those type of appointments for folks who are not Caucasian. And I think that's a good thing, because a lot of those folks need a hand up because we actively hurt them for many, many years prior to 1974. And when I checked it, my mom said, Kelly, you need to check American Indian, honey, because believe it or not, I'm 1/8 Cherokee. And no, I'm not like a former presidential candidate, Ms. Warren, claiming it. I actually am. My grandmother Smith was half Cherokee Indian. Her mom was full. And I said, no, Mom, I can't do that. She said, why? And I said, because if I cannot qualify on my own merits, I don't want the preference. Now, I worked hard, put myself in that opportunity. I know hundreds and hundreds of people like you who did. All we want in this country is equality of opportunity. We don't want equality of outcomes, which some in BLM and Antifa seem to be screaming for. Quality of outcomes means that you're guaranteed to get a certain level of earnings, a certain house, certain possessions, certain retirements. Societies that exist like that are doomed to failure, and all economic history shows they do fail. Those are socialist societies. We don't want any part of that in our country. We want our children to have opportunity. And then if they work hard enough and they pray hard enough and they do the right things and they make the right decisions, they've got a great chance to be highly successful. With that, I want to thank you for your time. If you have any other questions whatsoever, please come back to us via Facebook or any of our social media, or give us a call, give me a call, because we'd love to talk to you. We're going to continue to work very, very hard going through the rest of this year. I expect to see a positive result in all of our client accounts by the end of the year. That's an opinion, not a fact. But I believe economic history has proven me true in these type of pandemics, and it'll be true this time. God bless you and your families. God bless the United States of America.